Welcome back to Life with DJ Sessions. My NMLS number is 271823. Today in episode 9, I wanted to recap the first 8 episodes, kind of go over a little bit of what we already discussed and talk a little bit about future. In episode 1, I laid a blueprint out, kind of a roadmap on how to build wealth. In episode 2, I kind of gave more examples of that and actually centered around the mindset on building wealth. Episode 3, I talked about a credit score to get to 800, how to go about doing that. Episode 4, I went over the 4 pillars of real estate financing. Episode 5, I talked about the BRRRR method of building wealth through investment properties. Episode 6, I talked a little bit about renovation financing and what that can do. In episode 7, I talked about building an A team. And in episode 8, I talked a little bit about when you work for yourself, what does that look like? And so as we move forward, when we talk about, having the blueprint on how to go about doing it, if you have the right mindset, now you've worked on your credit and your credit score is 800 or even all close to it. You understand you've got the 4 pillars. I've got my credit, I've got some income, I've got some assets, and I'm looking to purchase some properties. Maybe I might go the BRRRR method where, I want to buy, repair, rent, refinance, and repeat. I may want to look into purchasing a property and then doing some renovation to it, maybe to live there as my primary residence. Maybe you've built, you started building your A team by, contacting an attorney, a financial advisor, a CPA, you've now got a mortgage lender, real estate professional, insurance agent. And then maybe you work for yourself and maybe you don't. But, I wanted to talk a little bit about just having a framework around what's out there in the marketplace when you're looking to purchase real estate properties, right? So if we start with, let's say I want to purchase or you want to purchase a home as your primary residence, right? And maybe it's your first time buying a home. Now, the way the rules are set up is that the first time buying a home, you just basically means you haven't owned real estate in the last 3 years. So you could have purchased a property 10 years ago, maybe sold it 3 years ago. But if you have not been a homeowner in the last 3 years, you're considered a first-time home buyer. What does that mean, right? Well, what it means is the government says, all right, we'll allow you, and I say the government, but really it's the entities that lend the money out there. And I'm talking just the conforming qualified mortgages. So they say, listen, we'll allow you to purchase a home with as little as 3% down, right? So when they typically came out to buy a home, you got to put 20% down, right? $100,000 home, well, you got to come up with 20 grand. Right? I mean, that's how it was. Well, now, by being a first-time home buyer, they're saying, listen, you just need 3%, right? And then not only that, that 3%, depending upon, other factors, could come to you in a form of a gift, right? It can, in some cases, come to you in a form of a grant. So in some cases, you're actually not coming to closing with a lot of your money that you've paid for by being a first-time home buyer. FHA, which FHA is a product that says, maybe there are reasons why we're going to do an FHA loan, right? So maybe you decide you want to purchase a multifamily as your first property, as your primary residence. Again, FHA is for primary residence only. It's not, to be an investment property. Now, yes, if I buy a 3-unit, 4-unit duplex, as my primary residence, yes, in theory, I am renting out the other 3 units, other 2 units, other 1 unit. And so, yes, that would be in the form of an investment. However, but I live there as well. And the way that works is you have to live in the property for at least 12 months. Okay. After you lived there for 12 months, you've satisfied, you can then move out. And that other unit that you were occupying, it can then be an investment property. And then but some people, FHA will allow you to have one one property for an FHA loan. Okay. So you can't use it again for another property, right? For just now. And keep in mind, now that you own the property, you're no longer a first time home buyer. So now you kind of fall into the other rules. And so what are some other rules out there? Well, let's say I want to move out of that FHA home. Maybe it's a fourplex that I bought and I don't want to live there anymore. Now I want to buy my own primary residence. I want to move out of where I was at. So now I can go conventional with just 5% down as a minimum amount, right? Now I could do 20%, I could do 15%, I can do 10%, but the minimum is 5%. Okay. That is a standard conventional loan. Now, if again, remember, if you're not putting 20% down, then you're going to have to pay private mortgage insurance, which is another word you hear out there called PMI, right? And so, what is PMI? Well, PMI says that if you don't pay your loan, then we're going to make the lender who lent you the money to buy that home, we're going to make that person whole, right? Because you're paying an insurance premium just because you didn't put enough down. We're not sure you're going to make those payments, so we're going to make you pay an insurance policy just in case you don't, right? So whether it's right or wrong, it is what it is, right? So now when you're talking about, so now I have, so in this scenario, now I've got my multi-unit that I bought as FHA. I've lived there over a year. I moved out. I'm buying my second home, but I'm buying it as my primary residence. So now I'm putting 5% down. So now I own a property over here, my 4 unit, and then now I have my other primary residence and I'm living there and everything is great. Now, DJ, I want to buy another investment property. Things are going really well for me. What do I got to do now? Now, well, you can put as little as 15% down. Now we're talking a single family unit, right? This is a single family home. But wait, didn't you say that if I don't put 20%, I got to pay PMI? That is correct. You do have to still pay PMI, but you can get as low as 15%. Most investors that I work with do put at least 20 to 25% down. But if if 15% is all you have, that's the minimum. Okay. So now I purchased my third property, single family. Oh, you know what, DJ? I want to buy a fourth property, but this one I want it to be another multi-unit. I want it to be a duplex. Great, you can do that, right? 25% down. Now you would think though, after having your fourplex that you bought in the beginning, and now you bought your primary, but then you went and bought an investment property, that you have now managed your cash flow. That A team that you set up is helping you manage that cash flow. And so you are on your way. Now, can you just keep on buying? Absolutely. The beauty of this system is that you can purchase up to 10 properties, right? And this is when I say up to, meaning you can finance up to 10. You can buy more. But, the way the qualified rules work is it says, hey, listen, we'll insure up to 10 properties plus your primary residence. Now, so let's say in the same example, you bought your, again, you've already bought your 4 unit, you bought your primary residence, you bought an investment property, then you bought another investment property. So then, on maybe your fifth property, you say, you know what, I really just want to buy another home, but maybe I want it to be near warm weather. Maybe I live in the cold weather. I want to have a vacation spot for my family. DJ, what do I got to do for that, right? You just need 10% down in most cases. Okay, some cases 20%, but in most cases 10% down. It's my second home, right? Kind of like in a vacation spot. This can't be just down the street, but it's your vacation home. And so when you talk about up to 10 properties, that's a decent amount of property in real estate that you can purchase to help build your portfolio. And I say again, the government, but you may say, well, Fannie and Freddie, those just government-backed securities and it's traded on the market. Yes, there's some pluses and minuses. I guess I kind of look at, if it's backed by the government, if we're conforming to government standards, it's all the government. And the other ones, I know the Fed's printing the money, but it's government type loans. So these are some options out there for you. One other thing I wanted to mention is, well, two other things I wanted to mention. One, so when you own these real estate properties, the one thing about real estate, remember, it's not liquid unless you make it a liquidity event. So you pay off the loans, you got all these properties out there, and let's say you've amassed a real estate portfolio of, say $1 million, right? You've got 7, 8 properties. the value 200 there, 150 there, 300 there. All your real estate portfolio is $1 million. But is that $1 million liquid? Can you go to your home and open up a wall and find cash? No, right? So in order to do that, you've got to refinance, right? You got to pull some cash out of it. And so some of the rules change a little bit when you're looking to pull cash out. So if it's, let's say, you're an investment property that you own outright, but you want to say, you know what, I own, the value is $100,000, but I want some cash. How much can I get out of that? 75%, right? So I can give you 75% of that money back to you in the form of liquidity. Yes, it'll be a loan, but again, that's how when you're purchasing it on one end, but then you can refinance to pull some cash out of it. And the other caveat I wanted to mention, so you've got purchase and you got refi, is when we talk, some people talk about, well, can I buy a home where maybe it's a rental property, but can I treat it as a rental, but not let it count against me? There are some circumstances where you could purchase a property. You've got maybe a lease on hand, and you've got the appraiser can do a rent schedule for the appraisal. So there are ways to purchase properties that's already cash flowing. That way, it doesn't affect your overall debt ratios. And finally, I want to mention, there's some people ask about large deposits. What does that mean? Well, a large deposit is defined as a single deposit that exceeds 50% of your total monthly qualifying income, right? So if I get $5,000 a month of salary income, but there's now a deposit in my account, $8,000 of cash, we want to know what that's from, right? Where'd that come from? And so, we want to, when you're talking about, cash deposits, large deposits, at the end of the day, it could be two things. One, you could have got a loan over here, right? Well, we want to make sure we're factoring in that loan payment into your ratios. And then two, you could be simply trying to hide money and they're depositing money in cash. And, we just want to know about it. So, I think sometimes the obvious is obvious, where if you've got cash being deposited, if you can justify where it came from, it's not a problem. But if you can't justify it, then that's it's a problem. So, pretty cut and dry. Thank you again for taking the time. And again, this has been another episode of Life Lessons in Financial Empowerment. Thank you. Enjoy the rest of your day.